This is a requirement for individuals with income from sources such as rental properties, investments, and self-employment. Understanding provisional tax. What is provisional tax? Provisional tax is a type of tax that allows taxpayers to make advance payments throughout the year. This is particularly useful for individuals with non-salary income, such as those with rental properties, investments, or self-employment. By making these advance payments, taxpayers can avoid penalties and interest on their tax bill. Tax authorities estimate income and expenses to determine provisional tax liability. However, if they have other sources of income, such as rental income, dividends, or capital gains, they may be considered provisional taxpayers. Understanding provisional taxation. What is provisional taxation? Provisional taxation is a system used by the tax authorities to determine an individual's or business's tax liability. It is called provisional because it is based on an estimate of the taxpayer's income and expenses, rather than an actual calculation of their tax liability. Key features of provisional taxation. The tax authority estimates the taxpayer's income and expenses based on their previous year's tax return. Types of provisional taxpayers. There are several types of provisional taxpayers, including individuals who receive income from self-employment, such as freelancers, consultants, and small business owners. Renters who receive rental income from property they own or rent out. Investors who receive income from investments, such as dividends, interest, and capital gains. Individuals who receive income from a trust or estate. Provisional taxpayers must pay tax on their income, even if they don't meet traditional tax thresholds. Understanding the provisional taxpayer status. If you are a provisional taxpayer, you are required to pay provisional tax on your income, even if you do not conduct any business or your taxable income does not exceed the tax threshold for the tax year. This means that you are considered a provisional taxpayer if you meet any of the following criteria. You are a self-employed individual or business owner. You receive income from a source that is not subject to withholding, e.g., rental income. Capital gains. You have a taxable income that exceeds the tax threshold for the tax year. Key characteristics of provisional taxpayers. Provisional taxpayers have certain characteristics that distinguish them from non-provisional taxpayers. Make timely provisional tax payments to avoid penalties and interest charges. Understanding provisional tax payments. Provisional tax is a type of tax payment that businesses must make to the Australian Taxation Office, ATO, to cover their tax liability for the financial year. The payment is made in installments, with the first payment due by the end of March following the end of the financial year, and the second payment due by the end of August. Key dates and deadlines. First payment due, March 31st, following the end of the financial year. Second payment due, August 31st, following the end of the financial year. Third payment optional, October 31st, following the end of the financial year. Consequences of missing payments. Missing the deadline for provisional tax payments can result in penalties and interest charges. LUS emphasizes the importance of making timely payments to avoid these consequences. Payment options. Payment by installments. Businesses can make payments in installments to cover their tax liability. Payment by lump sum. Businesses can also make a lump sum payment to cover their tax liability. Tips for making provisional tax payments. Tips for making provisional tax payments. Keep accurate records. Businesses should keep accurate records of their income and expenses to ensure they are making the correct provisional tax payments. Consult a tax professional. Businesses should consult a tax professional to ensure they are meeting their tax obligations. Plan ahead. Businesses should plan ahead and make timely payments to avoid penalties and interest charges. Understanding the SARS recalculated estimate process. The Canada Revenue Agency, CRA, provides taxpayers with the opportunity to request a recalculated estimate of their income tax liability. This process is available to taxpayers who believe their declared income is too low or inaccurate. In this article, we will delve into the details of the SARS recalculated estimate process, highlighting key points and providing concrete examples to enhance understanding. Eligibility criteria. To be eligible for a recalculated estimate, taxpayers must meet certain criteria. These include the taxpayer must have filed a tax return for the relevant year. Paying provisional tax throughout the year to manage cash flow and avoid penalties. Understanding the SARS Provisional Tax Payment System. The South African Revenue Service, SARS, requires taxpayers to make provisional tax payments throughout the year to cover their tax liability. This system is designed to ensure that taxpayers pay their tax in installments, rather than all at once, to help manage their cash flow. Key features of the Provisional Tax Payment System. Taxpayers must make 4 provisional tax payments per year, typically in March, June, September, and December. The amount of each payment is based on the taxpayer's previous year's tax liability. Taxpayers can adjust their provisional tax payments if their tax liability changes during the year. Understanding the consequences of late payments. Late payments can have severe consequences for taxpayers. The most immediate consequence is the 10% penalty imposed by SARS. This penalty is calculated on the amount of the late payment and is deducted from the taxpayer's refund. For example, if a taxpayer owes R100,000 and pays it 30 days late, they will be charged a penalty of R10,000. The penalty is in addition to the interest charged on the unpaid amount. The interest rate is currently 11.5% per year.